So we're doing a more complex cash budget that's going to include cash disbursements and cash receipts at different times. And let's just get started. So this is a company, they prepare monthly cash budget, and here's all the information. We've got sales, direct materials, direct labor, manufacturing overhead, and selling and administrative expenses. So this is a total cash budget. All sales are on account, so no cash sales. They expect collections to be 50% in the month of sale, 40% in the first month following sale, 10% in the second month following the sale. And so that is so there's no bad debts. It pays 30% of direct material purchases in the month of purchase, and the balance, which is 70%, due in the following month, in the month following the purchase. Other data is as follows. So we've got credit sales. We know how many, so this is sales. All sales are on account. So we've got credit sales, November, this is November 2022 because we're dealing with 2023, and there's December. We've got purchase of direct materials in December. We've got other receipts, January. We've got the collection of a note receivable in February. We have the proceeds from the sale of securities. And then other disbursements, February, payment of $20,000 for land. The company expects its cash balance on January 1st, 2023 to be $50,000. It wants to maintain a minimum cash balance of $40,000. So the first thing we've got to do is prepare the expected collections from customers and then the expected payments for the direct materials, because this is one of those cascading questions where we have to calculate exactly what we're going to either receive or pay out every single month. And then we're going to do the whole cash budget. So let's get started. We're going to do the cash collections first. So let's look at the cash collections. And I'm just going to repeat exactly what happens. So 100% on account. All right, so it says 100% are on account. And so wait 1 second, we've got January, February, 100% on account. So of that 100%, 50% is in the month of sale. And then 40% in month following sale, and then 10% in the second month following sale. All right, so as usual, I'm going to do my January and February, but I have to remember that this is going to represent 3 months. So I probably need to go back because I'm going to do this for each month. So I'm going to do January. So I'm going to do January here and February here, but I need room for the month before. Actually, if I'm looking at January, this is probably too close. Let's move it over a bit. I'm going to do February way over here. I'm going to do January. I'm going to do December, and I'm going to do November. There we go. All right. So now I'm going to do November here, and then I'm going to do December. So what do we know about November sales? And I can go down. Let's just go down so we can see what I'm talking about. So let's go down to January down here. So I know that in January, 100% of all sales are on account. So, but 50% are collected in the month of sale. So looking at this information right now, I know that 50% is going to be collected in January, okay, because they're all credit sales. And then 40% will be collected in February, and then 10% will be collected in March. All right, and we know that the total sales for this whole period of time was, we're going to look over here for January, $350,000. All right, so now January to January, I'm going to do 50% of 350, which, if I remember correctly, is 175. Just going to check. 175. So January to January, I'm going to take 350,000, multiply it by 50%. So this is 175,000. And then 40% will be collected in February. So 350,000 multiplied by 40. That's 140,000. And then if I had March, I would do March. I can now do, let's just do February before we go backward. We got 50% in February. We've got 40% in March, and then we have 10% in April. What are the total sales in February? Total sales in February are 400,000. So 400,000 multiplied by 50% February to February is going to be 200,000. And then if I had March, I could do March also. I don't have March, so I can't, but if I had March, I could do March also. So now what I've got to do is I've got to go backwards. I have to look at November sales, right? So what were November sales? November credit sales were 200,000. So I know November credit sales were 200,000. I know November to November will be 50% in November, 40% in December, and then 10% in January. So I'm going to take 200,000 multiplied by 10% to move it over. I could fill out all of November if I wanted to, but I'm only doing January and February. I just wanted to be aware that in January, I'm going to collect 10% of this, which of course is $20,000. Because I'm going to get 10%. Now, if I go to December, I'm going to do 50% in December. I'm going to do 40% in January, and I'm going to do 10% in February. So what was December sales? Total December sales, $280,000. So I'm going to take the 280. I don't need to do December. Multiply it by 0.4, January to January. So that is going to be $112,000. And then 10%, which is $28,000, is going to be February. So notice I've got three. I've got January, December, November, and I've got February, January, and December. As long as I know, and if I kept going, it would be a cascading effect. So I'm going to calculate exactly how much I'm going to collect in each of these months. So that's 20 plus 112, and then I'm going to add 175. So what am I collecting? 307. 28 plus 140 plus 20 is equal to 188. I've done something wrong there. 368. So that's my cash collections. That's the first thing I need to calculate. And just to remind you, this is 400,000 multiplied by 50% goes over here. I could write it up here, but I'm not going to do it because it's very clear. 400,000 multiplied by 50, February to February. So now let's look at the cash disbursements or cash payments. All right, now looking over here, it says it pays 30% of direct material purchases in cash in the month of purchase, and the balance due the following month, the balance due in the month following the purchase. They could say that in a simpler way, but so what they're saying is 70% is paid in the following month. So let's just see. We're going to pay 30% cash in month of purchase, and then 70% on account, and this is paid in the month following purchase. Right? So again, I need to look, do I need to look at November and December to figure out January and February? I don't think so, but let's just see. Okay, I'm going to leave some space just in case I need November and just in case I need December. And now I'm going to do January. So what are the purchases in January? So January direct material purchases were $120,000. And remember, 30% are paid in cash. So 30% cash. So that's 120,000 multiplied by the 30%, January to January. This is going to be January to January. And so here we go. That is equal to 36,000. I'm going to pay in January for January purchases, but I'm going to pay 70% on account. This is credit, and I'm going to pay that in February. So 70%. So I'm not going to pay it subsequent and subsequent. These two added together are equal to 100%. So I'm going to do 120,000 multiplied by 0.7, 84,000. So there's only 2 months. So if I look at February, I'm going to do 30% cash in February, and I'm going to do 70% credit, and I'm going to pay that in March. So how much here, I know that I purchased this much. How much did I pay, or sorry, pay? How much did I purchase in February? I purchased 110,000. So now I can take the 110,000 multiplied by 30%, February to February, 33,000, 33,000. This is going to be in March. I don't have a March. I only need 2 months. So I don't actually need November at all. I only need December. So how much were direct material purchases in December? 90,000. So in December, I did 30% cash in December, and then I did 70% credit in January. And how much was the total? The total amount was 90,000. So I don't need December. I just need to do January. So I've got 90 times 0.7. That is 63. If I needed to December, I could put December, I could put November. I don't need it. So now this is telling me how much am I paying in January? $99,000. And then February, 117,000. So now I know what are going to be my cash collections in January and February, and what are going to be my cash disbursements from direct materials only. So cash payments for direct materials. In January, 99,000, and in February, 117,000. So now I can take this information because I have to create a cash budget for the whole 2 months. So I have to recognize that there are going to be other payments in those 2 months. So let me get rid of these other pieces of paper. I need this. I don't need this right now. There we go. Okay, so I'm going to do the company's cash budget. I'm going to put down the company's name. And I'm going to do a cash budget and 2 months ending February, February 28th. What's the year? 2000, February 28th, 2023. All right. So now, of course, I'm going to have January and I'm going to have February. Okay. And I could do a total, but I'm not going to do a total. We've got enough complexity here anyway. We've got the beginning cash balance. We have to be given the beginning cash balance for January. The company expects its cash balance on January 1st, 2023 to be $50,000. We can't put this number in yet because we have to wait until the end of January before we can figure it out. So we're going to add cash receipts. So we've got collections, and we can split up the collections on the credit sales, and we're going to do that. So collections on sales. We know this from our calculations, so we're just going to take it. January is 307,000. Now let's see if there was anything else we needed to take into account. That's no. Other receipts. January, collection of December 31st, 2022, note receivable, $5,000. So that's $5,000. And I don't think we have anything else. Now what is here? Proceeds from sale of securities, that's in February. There's no collection from the sale, but I want to include it in here. So I'm going to look at total receipts. Which is just these three added together. So that's 315, 312. Oops. 312. And then what is the total available cash? That would be the opening plus the receipts. And that's 362,000. So now we're going to do cash disbursements. And oops. Okay, what are we going to start with? We're going to start with direct materials. Now we know what the direct materials are because we did that. Here's our cash payments for direct materials, $99,000. Now we need our direct labor. Direct labor, and it says, let me see, I'm just trying to think. Other disbursements, doesn't look like there's anything else. Just double checking. Nope. It doesn't say anything about us paying these people later. Not that I see anymore. Anyway, so that means we're paying all our direct labor in the month that it is incurred. If nothing is indicated, then it's going to be in the month incurred. And that was 85,000. There's no indication that the manufacturing and overhead includes depreciation. If it included depreciation, we would have to deduct it, but it doesn't say that, so we're just going to leave it at 60,000. Same with the selling and admin. There's no indication there's depreciation. If there was depreciation, we would deduct it. Now, is there anything unusual? Other disbursements in February, payment $20,000 for land. Purchase land. I want to put that space in there, even though there's nothing in January. And this appears to be all of our payments. Let's just add that together. That's 319,000. Okay, so now we've got cash. Basically, we've got the difference between the cash receipt. Oh, sorry, no. We've got the difference between the total available cash and the total disbursements. This is the cash balance before the adjustment. So that's total available cash minus the disbursements, minus the 319, 123, 43,000. Now, what do they expect to have? Minimum cash balance of $40,000, and we have $43,000. So that means financing, which is usually the borrowing, and then the repayments, and the interest expense. This is all going to be nothing, nothing, nothing. Why? Because total financing is going to be equal to 0, and then the ending cash balance is just going to be equal to the 43,000. I'm going to take that 43,000 and I'm going to bring it up to the opening balance on February 1st, 43,000. And then I'm going to start the process over again, using again what I already determined, cash collections, 368,000. We don't have a note receivable anymore because that was last month, but we do have a sale of securities. Here we go. Proceeds from sale of securities, 6,000. Nothing here. 6,000. This is going to be total cash receipts, which is just these two numbers. $374,000, and now we want total available cash, which is the opening plus the receipts, $417. Now we're going to look at the disbursements. So direct materials, we calculated it right here, $117,000. Direct labor was 112. Manufacturing, no depreciation, so we don't have to deduct any depreciation to get the cash. No depreciation from that. And then we purchased some land. Payment for land is 20,000. So this is going to be the total disbursements. That is 404. There we go. Now we need to know what is the cash balance at this point. So we take the available cash, deduct the total disbursements. Oops. This is equal to 13,000. All right, but remember it said that we wanted a minimum cash balance of 40,000, and we don't have 40,000. So we need 40,000 down here. To move from 13,000 to 40,000, I need to borrow $27,000. So I'm going to borrow $27,000 at the end of February, which means I don't have a repayment and I don't have any interest. So there is my cash balance at the end of February. All right. Hopefully that has helped you. Wait, I'm going to zoom out so you can see the whole thing at once. There is my cash budget for January and February. Hopefully this helps you to understand cash budgeting better.